Market cycle and base counting. So these are the stages of the market cycle. You have accumulation, markup, distribution, markdown, and another accumulation to start the process all over. So this is the accumulation stage. In the accumulation stage, the stock is still in consolidation. It is moving sideways. It moves within a range and it oscillates around the 200 period moving average. The volume is low. The accumulation stage prepares for an emerging bull market trend. So in the sideways movements, early speculators and insiders and big money are slowly buying. But they don't want prices to move up too high because they are still accumulating and their shares are not yet completely filled. So they keep prices down and then they buy when prices are down. When price moves up, they try to prevent these price moves by putting in large sell orders at the ask areas. So sometimes you wonder why there are millions selling at the selling area at such a low price. It's probably an insider who's trying to accumulate more shares and he doesn't want you to buy up the prices. He's trying to scare the market into thinking that price will tend to fall because there's a huge selling at the ask side. So in effect, he wants to take your shares from you. So these sell orders at low prices could be scare tactics from big buyers. I'd like to introduce you to the on-balance volume indicator or the OBV. This indicator tells you whether there's accumulation or distribution. If the OBV is increasing, then there is accumulation in the security. If the OBV is decreasing, then there is distribution. So you find that during the accumulation stage, if the OBV is increasing, then you know that some insiders are buying. Some speculators are trying to get into the position at low prices. So even if there's no activity, it doesn't mean that the market is not paying attention. Just because the price is working within a range doesn't mean that there are no buyers or no one's interested in it. We can see that the OBV is increasing while the price is inside a trading range. It took 2 years for the price to get out of that trading range. So the longer accumulation period, the stronger the move that tends to happen afterwards. After the accumulation stage is the markup stage. This stage is also called the bull market. Price breaks above the accumulation range and the OBV continues to move up because the market is still accumulating more shares. When price increases, there is huge volume, there's increasing volume, but when price consolidates sideways, as you can see when price formed a triangle in this area, the volume is lower. So every time price moves up, the volume is higher, and when it consolidates, the volume is lower. So this is how you know that you're in the markup stage. So the markup stage continues until the market experiences a buying climax. After the markup stage is the distribution stage. In this stage, the market will start to sell off. The market opens high and closes low, resulting in a long red candlestick. The OBV also moves sideways to downward during this stage. The selling is fast and furious and sends a signal to the bulls that the rally is over. So after the sharp drop, the price may bounce a little bit upward, and then this gives the bulls a false hope, false sense of confidence. It encourages the bulls to hold on to their positions and then adding on dips. But this is likely to be a bull trap. The big money has to send off the impression that they are still there, that they have not sold their shares. This is why they are supporting the prices. But every opportunity they get, they dump shares in the market little by little in a way that the market will not notice. They have to hide their selling because if the market realizes that the biggest buyers previously are selling their positions, they will sell as well and there will be no buyers left. So this big money wants to sell their positions at higher prices, so they give away a false sense of hope to the bulls so that they can sell at higher prices. So the markdown stage is commonly called a bear market. It begins when the price breaks below the uptrend line and the 50-day moving average. So the OBV is also decreasing and there are lower highs and lower lows in prices. So what do you do at each stage of the market cycle? During the accumulation stage, you monitor the OBV. Check out if the OBV is showing accumulation. Put it on the watch list for possible bullish reversal and also assess if there are important fundamental developments. Is there anything happening to the company? Is there a bullish crossover, moving averages, etc.? So what to do during the markup stage? Go long. Use trend trading strategies and watch for signs of a bearish reversal. Just keep holding until the price is making higher highs and higher lows. During the distribution stage, you avoid this stage or you sell your position. Markdown, you must already be out of the market during the markdown stage because you only want to trade with the trend and not against it. And then the cycle starts over again. It may take longer, may take shorter. Accumulation periods are often long and boring. This is how big money is able to accumulate a lot of shares because the market is not paying attention to it. This is why it is better to enter during the markup stage because accumulation stage could take years and you'll get bored out of your position. During the markup stage, if you've confirmed that there's an uptrend, then you can simply manage your trade by looking at the support lines and holding it as long as price is above support. Now, the only part of the market cycle that actually matters to traders like us is the markup stage because the Philippine stock market is a long-only market. We can only trade going up. We can only trade the markup stage. Now, if you trade foreign markets, you will also be able to take advantage of the markdown stage when you go short on a declining stock. So this is not something that we will do in our local stock market. So we'll focus more on the markup stage. Now we will further dissect the markup stage by looking into what it is comprised of. The markup stage is comprised of several bases. As we previously discussed in the topic on trends, price does not move in a straight line. It moves towards its direction and then it enters some sort of sideways consolidation before it continues on its direction. These sideways consolidations are what we call bases. In a certain markup stage, there are at least 4 bases. This shows the chart of Macro Asia Corporation when price broke above the accumulation stage and therefore price also went above the 50 EMA, 200 EMA, and 20 EMA lines. Price officially entered the markup stage. Now this bullish crossover and breakout above the accumulation stage is your trigger to open long positions. Now after that breakout, we see that price started to consolidate within base 1. At this area, skeptics are shaken off their positions, thinking that the move is probably a bull trap. However, the skeptics were proven wrong when after price consolidated from March to July of that year, price broke above that trading range. Now, this price breakout above the base 1 attracts momentum traders to enter. So bases 1 and 2 are good entry points to ride the new trend, but you have to set stop losses below the bases or below the 50 EMA line. Now at base 3, the trader should simply hold and respect the stop loss point set. Remember when we discussed channels earlier, supports and resistances, we talked about stop loss points, or what we also call cut loss points. This is the point wherein we cut our losses in case we are wrong in our bias. So we trail our stops because we are in an uptrend. Now once price enters bases 4 and 5, the trend would have already captured the general market's attention. So this turns into what we call a crowded trade. A crowded trade is one in which everyone's already in on this uptrend that there's nobody left to buy it. Do you remember the time when everybody was talking about Bitcoin and Bitcoin was at $20,000? I hear about Bitcoin everywhere. I see people in the parlor talking about it, people in the streets talking about it. In all forums, most forums that I go to, people are talking about the bull market in Bitcoin, and suddenly Bitcoin dropped towards the 3,000 levels within the same month. So when everybody's in on the trade already, there's no one left to buy it up. This is the reason why prices start to drop. So when you're already in the 5th or 4th basis, the risk to reward situation is less favorable for you. So you should be careful because the markup stage is already at its maturity. So if you see a sign of weakness and you're a trend trader and price breaks below the 50 EMA line, you would already close your position. But if you're a momentum trader and you trade for short-term purposes, you should use the 10 or 20 EMA line as your support line and cut loss below that. The same goes for a swing trader. If price breaks below the 20 EMA line, then that is a good time to close your position. Now, see how price formed a lower high when in base 6, price tried to break above that the highs of base 6, but it failed. So this resulted in a breakdown in prices. It formed a lower high. It showed the sign. It's a sign of weakening momentum, and it's a good area to take profits. So if you trade using bases within the markup stage, then you are more likely to know when price is about to reverse simply by counting the bases. Once price exceeds base 4, then you know the price is already, or the momentum is already weakening because there's too many people in the trade. This is also the chart of Macro Asia Corporation, and this is what happened after price peaked out at base 6. Within the markdown stage, we can also assess whether the move is overextended by counting bases. As you can see, prices don't go down in a straight line in the same way that prices don't go up in a straight line. It has to consolidate sideways before resuming its trend. So this shows 3 bases on the way down and then an accumulation after base 3. So in base 4, the market started accumulating shares once again. So this begins another cycle for Macro Asia Corporation. So I'd like to show you more examples of the bases in some of our blue chips. First is Ayala Land Inc. Let's go to the chart. Here's the chart of Ayala Land Inc. The ticker is ALI or ALI. So let's draw the bases in the chart of Ayala Land Inc. We start off in 2009 when prices bottomed out after the financial crisis. So here are 5 bases. Let's label them bases 1, 2, 3, 4, and 5. So you can see how Ayala Land's price went up in 5 bases and currently it's already forming lower highs. So probably peaked out already. This is the uptrend line which Ayala Land broke and already formed another base on the way down. This is already base 2. The previous chart is also considered base 1. I'm sorry, the previous box is already considered base 1. Now we will add the moving average lines, the exponential moving averages. Let's start off with the 200 line and we'll choose the color red. And then we'll also add the exponential moving average line 50. Now you can see how price already broke above that EMA 200 line previously. And then we'll add the EMA 50 line. So we click on moving average exponential, change the value to 50, and change the color to orange. Of course, you can choose any color you want. I would just like to explain later why I choose these colors. And then we also add the 20 EMA line as well. We color that line green. So you can see that at that breakout above that accumulation, there's already a buy signal or a bullish crossover with the moving averages. So we have a confluence of buy signals. We have a breakout as well as a bullish crossover. But at this area, we also see a bearish crossover. This is at the end of base 6 or base 5, sorry. We see a bearish crossover happening on the moving average lines. So a bullish crossover is when the 20 and 50 are above the 200 MA, and the bearish crossover is when the 20 and 50 are below the 200 MA. So you can see that the 200 MA serves as resistance to price when price tried to break above that but failed. We choose the colors green, orange, and red. For easier recall, if the green is above the yellow and the red, then we have a go signal. If the red is above the green and the yellow, then we have a stop or a sell signal, just like in a traffic light. Now let's check out the same pattern in SM Investments. The ticker for SM is SM. Alright, so we draw the same basis in SM. As you can see, we already added in the moving average lines. This is the base 1. This is the accumulation area. And then you have base 2. Base 3 is often the biggest base. So it's often the biggest box. And this is base 4. So SM only has 4 bases on the way up. So what do we see? Price had already broken below the uptrend line in the bearish crossover seen here. We also see the buy signal at the start of the move in this bullish crossover when the green and orange lines went above the red line. So that's a go signal to buy. Now let's check out the chart of Alliance Global or AGI. Now sometimes it's easier to find the bases using the weekly chart. Sometimes it's easier to find bases using the daily chart. In this case, we will use the daily chart. Alright, so we'll draw the bases again for AGI. The bases do not have to be stuck beside each other because there are periods when the price just moves up and doesn't consolidate. So we only count the consolidation periods. So we can see the bullish crossover in this area. And then price went on an uptrend. And here we see a bearish crossover. So that happened at the 4th base. So you already know that at the 4th base, price might reverse direction. So if you count the bases, you already know that it's time to be more vigilant. So we number them as well. 1, 2, 3, and 4. So since you already know this, it would be smart of you not to enter a trend if you're already on the 4th base because the risk to reward is not as good. So you see we drew an inner trend line and an outer trend line. If you are a momentum trader, you would draw the inner trend line as well. There's a confluence of support at the inner trend line and the moving averages. Since price broke below that, then you would have sold already. You can also follow the outer trend line. So you can see on the way down, we already drew some bases as well. So we have 2 bases of consolidations already, 3 bases already, and this is the 4th base. But we are not sure yet whether this is already the end of the markdown stage because price is still oscillating sideways. It still needs to break above the resistance at the EMA 200 line. So you can see price can still go back to that previous bottom at near 2 pesos. So until it shows a breakout above that last box, then we still assume that it's on a downtrend. But we already know that this downtrend is maturing already. So we are also prepared to buy as well in case a breakout happens. In this case, although price is above the downtrend line, it's still not above the box. The box is serving as range resistance for the price. So we can still possibly see this box down here if price could not break above that resistance line. You look closely, there's a buy signal, but there's so many false signals here. This is the line it has to break. It has to break above that 1320 price. So we have a confluence of resistance at these areas. the resistance of the box, and also the range. The good sign is, the bullish sign is that it's above the 200 EMA, but we still have to wait and see if this is a false signal. So on the same chart, I'd like to put our knowledge of volatility, contraction, and expansion into use. As we've already learned previously, moving averages contract and they expand. Contraction is also called a squeeze. So it is actually a cycle. At this area, the moving averages are contracted, they are quite close together. And then when a move up starts, it expands. After an expansion, we see another contraction when prices consolidate. So this is also, contractions happen within bases. And then we have a huge expansion here. Price made a strong rally upward. So this is a huge expansion in moving averages at this area. So we will extend this box further. The expansion actually happened up until the tip. And then there's a contraction sideways after price broke below that MA 200 line. Then another expansion. And another contraction sideways. And another expansion here. Now price is currently moving sideways, but we don't know yet whether this will result in a buy signal. What we know is that we must not enter a downtrend. We must not enter the markdown stages. These contractions and expansions allow us more optimal timing in entry and also in exit. So after a huge expansion at the 4th to 5th or 6th basis, you're already prepared to sell your positions once price breaks below the MA 200. Now I already also encircled these areas. After a contraction, we see buy signals happening or sell signals happening. So here we see buy and sell signals after a contraction. So of course, after a price consolidates, there's always a direction that price has to take. There's also fake buy and sell signals within a pattern. So we have to be vigilant whether that buy or sell signal will actually push through. So this is the reason why we have to wait for prices to consolidate before we enter or exit a stock. A position trader looks into the medium-term trend. He uses the 50 EMA as support line. He continues to hold this position as long as price is above that and cuts his losses if price breaks below that. So he has a medium-term time frame. He's not faced by the small movements of the stock in and out. He more likely uses the medium-term trend line and the 50 EMA line rather than the shorter-term trend line. So he has to have the time and the capital to hold on to his position and has higher liquidity. What trading strategies does each kind of trader employ in his trades? Position trader buys and holds between weeks to months. A swing trader buys the dips and sells the rip. A momentum trader buys high and sells higher. This chart shows where a position trader buys and sells. Previously, we said that the 50 EMA is the position trader's support line. So this is the best place to position. But this time, we will add an indicator called the MACD. The MACD is an indicator that tells you trend direction. The MACD has two lines, the fast line and the slow line. When the fast line, in this chart it is the blue line, moves above the red line or the slow line, that is a buy signal. But when the blue line moves below the red line, it is a sell signal. So your entry levels are at the short-term consolidation at 50 EMA or the medium-term consolidation at 200 EMA, and when the MACD is near equilibrium. MACD is near equilibrium when the fast line and the slow line are together or converged. If you check out the moving averages at this time, when the MACD is near equilibrium, the moving averages are also quite close together. They are attached to the price and they are in a tight squeeze. So we can tie this in with what we learned earlier about moving average volatility. The best place to buy or to enter a security or a stock is when the moving averages are contracted together, not when they are expanded. So we sell below the 50 EMA and when MACD is below equilibrium. So how do we scan for position trades? We look for stocks whose price is above 20, 50, and 200 EMA. Therefore, the trend is up and the MACD is above 0. We also want to look for stocks that have a high value traded or a high liquidity. So we want to avoid third liners or stocks that are illiquid. Unlike position trading, which requires a lot of patience and requires a slower moving average line, momentum trading is a short-term trading strategy that uses shorter-term moving averages. As we discussed in previous sections, a good way to know whether a stock is about to enter a trend is through volume. Volume precedes price. An increase in volume shows an increase in interest in the stock. Therefore, if demand is high enough that it overcomes the supply, then the tendency is for price to move upward. In this chart, we see that there's exceptional volume at the start of the run, which shows accumulation. There's also increased volume at the end of the run, which shows distribution. If the volumes exceed the 10-day average volumes, then we have a likely candidate for a momentum trade. What are the early signals of a possible momentum trade? First, we have volume breakouts. Second, price range breakout. Third, the MACD is sloping up, which indicates trend direction. Fourth, the directional movement index indicates that the buyers are stronger than the sellers. And the ADX indicator is higher than 20. This indicates trend strength and therefore strong momentum. Now, there may or may not be fundamental developments behind the move. In a momentum trade, the best place to enter, as we mentioned earlier, is within consolidation patterns such as the bull flag and the bullish pennant. This chart shows where a momentum trader buys and sells. Prior to the move, we see that the volume is higher than the 10-day average. Now, what is the condition for a momentum trade? The 10 EMA should be higher than the 20 and the 50 EMA. Where do we enter? We enter on the breakout above the 10 EMA or above the box, flag, or pennant patterns. Momentum traders could also enter above the 3-month 6-month or 52-week highs or all-time highs. In terms of the ADX, it should be rising. The positive DI should be higher than the negative DI. The exit level is when price breaks below the 10 EMA and when the negative DI is higher than the positive DI. Now, where does a momentum trader take profits? As we said earlier, momentum traders do not want to wait for a long period of time. They just want to buy and sell immediately. So you take profits after strong surges since price could form a time-consuming consolidation pattern. You don't want to be inside that pattern as it consolidates. You want to be able to sell immediately. So when there are price surges, you sell and then you wait for a new pattern to unfold. When price breaks above that pattern, you re-enter and then you sell on the next surge. Wait for consolidation again and then you re-enter on a breakout and then you wait for the next surge and then you can sell your security. Here's another example. There's a long consolidation prior to that strong move. The moving averages are squeezed together. The volume is higher than the 10-day high and the volume average. The buy signals was when the price broke out of the box. As long as price is above the 10, 20, and 50 MA, we hold. Now, this is a very high momentum stock. So you can use the 5 EMA for stronger moves in order to exit quickly. Some traders prefer to use the 10 EMA, but for stronger momentum moves like this that are almost vertical, you can shift to the 5 EMA because the stronger the move up, the stronger the move down, and you want to be out of there as quickly as possible. So you can see the ADX was also strong. It is above 25, and the positive DI is above the negative DI. Now, when price broke below the 10 EMA, momentum traders are already out. Bounce players may wait for a chance to enter. Now, this is what happened after that price broke below that 10 EMA line. Traders have sold. Confirmation of downtrend is when 10 EMA went below the 20 and 50 EMA and there's a bearish crossover. The ADX also flattened, then weakened, and the positive DI went below the negative DI. How do we scan for momentum trades? The price should be higher than the 10 and 20 and the 50 EMA. The trend is up. The MACD is above 0. ADX is rising and positive DI should be greater than negative DI.